The 1929 crash, the 2008 crash, and the one nobody sees coming. There have been two crashes that rewrote the rules of money. A third is already being built right now, in plain sight, and almost nobody is looking at it. By the end of this, you'll see it too, and you won't be able to unsee it, because every crash, no matter the decade, is the same machine. It borrows to grow, then it eats itself. October 24th, 1929, Black Thursday. The market opened and fell off a cliff, down 11% in hours. Then something strange happened. A group of bankers walked onto the floor and started buying, propping the whole thing up. By the closing bell, it had almost recovered. The papers said the worst was over. The worst had not even started. The real collapse came the following week. Black Monday, October 28th, the Dow fell almost 13%. The next day, Black Tuesday, almost 12% again. By mid-November, about $30 billion had simply vanished. In 1929 money, roughly what the entire country had spent fighting World War I. And the mechanism was almost embarrassingly simple. Leverage. You could buy stock putting down just 10%. The other 90% was borrowed. When prices dropped, the broker called the loan. You had to sell. Right now, it didn't matter what price you got. That forced selling pushed prices lower, which forced more selling, which pushed them lower again. The structure ate itself. Nothing about the actual companies changed overnight, only the math did. Now here's what most people get wrong. They think 2008 was just 1929 in better suits. It wasn't. The leverage didn't disappear, it learned to hide. In 2008, the crash wasn't in stocks, it was in houses. Specifically, mortgages handed to people who could never repay them. Banks took those toxic loans, bundled hundreds together, ran them through a math model, and out came something rated AAA, safe, the same grade as government bonds. They had a name for these bundles: collateralized debt obligations, a lie wrapped in mathematics. Pension funds bought them, universities bought them, your grandmother's retirement account probably owned a slice. And the leverage from 1929 was still there, buried 3 layers deep. Banks borrowed short-term money to hold long-term mortgages, and the entire tower balanced on one assumption: that house prices would never fall everywhere at once. They fell everywhere. Borrowers walked away, and the machine ate itself again, faster this time. Lehman Brothers went from more than $600 billion in assets to bankrupt in a matter of weeks. AIG, the insurer standing behind these bundles, needed a $182 billion government rescue, or the whole system went dark. One man saw it coming, Michael Burry. He sat alone and read the actual mortgage documents, thousands of pages nobody else bothered with, and did the arithmetic everyone else skipped. The loans were engineered to fail, so he bet against them. When the crash hit, his fund returned around 489%. He had no secret information. He just did the work no one else would. Which brings us to now, because the leverage is back. It's not in stocks. It's not in mortgages. This time, most people can't even see where it's hiding. Today, the debt is sitting inside corporations. American companies are carrying more than $13 trillion in debt. For years, they borrowed at almost nothing, near 0%, and a lot of them didn't build anything with it. They used it to buy back their own stock. Fewer shares means higher earnings per share, even when the business is flat. The stock climbs. The executives cash out their options. Everyone looks like a genius. Nothing real got made. Then money stopped being free. Rates went from near 0 to over 5%. And even after recent cuts, they're still sitting near 3 3/4, with inflation refusing to die. That cheap debt now has to be refinanced at several times the old cost. Some companies can handle it, some can't. The ones that can't will be forced to sell, and the machine starts eating itself again. But there's a second layer, and this is what makes it worse than 2008. Trillions of dollars are now parked in things that almost never trade. Private equity, private credit, a market that has swollen to around $2 trillion, 5 times its size before 2008. Real estate funds. These assets don't have a live price. Their value is marked to model, which is a polite way of saying it's an estimate on a spreadsheet, not a number anyone actually paid. So when a pension fund says it holds $500 million in a private fund, nobody is bidding on that daily. It's a guess. And if that fund ever has to sell in a hurry, it can't, because the underlying assets take months or years to unload. So it dumps whatever it can sell fast: stocks, bonds, the liquid, healthy stuff, which drags those prices down too. The fire spreads to the parts that were supposedly safe. And here's the newest fuel on the pile. A huge share of that private credit is now funding the artificial intelligence boom. The data centers, the chips, the build-out. Wall Street estimates private lenders could supply more than half of the $1.5 trillion needed for data centers alone. Borrowed money, betting a technology pays off before the loans come due. If that bet slips even slightly, the leverage is right there underneath it. The truly frightening part is the opacity. In 2008, when firms blew up, at least we eventually saw who was holding the bag. This time, the exposure is hidden inside institutions that never have to tell you. One fund manager has no idea if the fund next door is one bad quarter from collapse. Nobody knows how the blocks are stacked until the first one falls. And the referee is weaker now. In 2008, the government could step in and bail out the system. Today, governments are far deeper in debt themselves. The United States now owes well over 100% of everything it produces in a year. Most of Europe is close behind. When the next fire starts, there is a lot less water in the tank. So the next crash won't look like the others. It won't be one loud crash on one loud day. It'll be slow. A fund breaks here. Money runs. Another breaks over there. Money runs from that too. It rolls for months, maybe years. You won't be able to buy the dip because you won't know which dips are bargains and which are the next domino. And here's the trap almost nobody escapes. Most people think they're safe because they've heard the words leverage, subprime. They think knowing the last war protects them from the next one. It doesn't. The safest place is the one place almost no one can stand to be. Cash, patience, and the discipline to wait while everyone around you looks like they're getting rich. But that raises an ugly question. If you see it coming and you step aside and you watch a crash quietly move other people's savings into your pocket, what does that make you? Careful or a vulture? The system breaks because too many people borrow. But if everyone stopped borrowing at once, it would break even faster. There is no clean way out. There never was. Every crash is the same machine. It borrows to grow, and then it eats itself. The only question that has ever mattered is whether you're still standing inside it when it does. That closing line is your T13, and the careful or a vulture beat right before it is deliberately engineered to split the comments, which is exactly what you want the algorithm to see. One operator note, this script is denser than the debt one. Have two voice hold a measured, calm pace on it, since the history and macro voice dies if it's rushed. The quiet bomb lines, the 30 billion, the 489%, a lie wrapped in mathematics, need a half beat of silence after them to land. Want me to run the vidIQ pass and hand you 3 ranked titles under 60 characters with matched thumbnail concepts? The packaging on a crash prediction video is where most of the CTR is won or lost, and title thumb redundancy is the usual killer.